Hello everybody, what's going on? Few important updates are coming from Nio. If you look at the headlines coming out of China right now, you would think the sky is falling for the Nio stock. Just few days ago, Nio founder and CEO William Li stood on stage at major science and innovation forum in Shanghai and dropped a headline that sent shockwaves through the retail investment community. He explicitly warned that under relentless pressure from outside investors, employees, and internal expectations, the company risks losing its determination. When a founder uses words like losing determination right before the earnings, short sellers salivate. The stock has been beaten down, noise is at all-time high, and retail investors are panic asking, is Neo thesis officially dead? Personally, I don't think so. I'm here to tell you, if you sell Neo based on this headline, you are completely misreading the room. Today, we are going to dissect what William Lee actually said, break down staggering financial turnaround happening behind the scenes, evaluate their brutal Q2 numbers versus Q3 setup, and I'm going to show you why NEO is positioned for one of the most asymmetric risk to reward turnaround in the entire EV sector. Let's get straight into the numbers. First, let me give you the exact context of what's happening in Shanghai right now. CEO William Lee spoke just 10 days out from NIO's Q2 earning call. He admitted that when a company navigates high-stake technology transition, outside pressure builds. Investors demand immediate short-term quarterly spikes. Employees panic under tight operational constraint. And as CEO, if you give it to every short-term whim to satisfy Wall Street next 90 days, you lose long-term determination. He didn't say Neo is giving up. He said Neo is actively resisting the temptation to compromise its long term ecosystem to chase quick artificial wins. Now let's address the elephant in the room. The stock sets down dramatically from its all time high of over $60 set back in January 2021. The narrative on the mainstream media has been Neo burn cash. Neo can't turn a profit. But look closely at the financial trends from end of 2025 into 2026. The financial picture is shifting dramatically from a cash burn startup to operationally disciplined powerhouse. In Q4 2025, Neo achieved a major milestone, its first quarterly GAAP net profit in company's history, posting 282.7 million yuan on the record revenue of 34.65 billion yuan and nearly 125,000 vehicles delivered. While they posted a minor GAAP loss in Q1 of 2026, as seasonality kicked in on an adjusted basis, Neo remained profitable at 43.5 million yuan. More importantly, gross margin skyrocketed. Vehicle and overall gross margin surged to 19% in Q1 2026, a 4-year high, up from a 7.6% just a year prior. Operational discipline, research and development spending dropped 40.7% year over year to 1.9 billion yuan. SG&A cost fell over 20%. They are trimming the fat without sacrificing core tech. Then we have got the balance sheet stability. Neo worked out of Q1 with 48.2 billion yuan in cash and cash equivalent, and net current asset flipped positive. Neo is not a company on bricks of bankruptcy. They have built a fortress cash chest that grants them year of runway to navigate this price war while pushing their vehicle margins near the legendary 20% mark. So here is the single most misunderstood metrics in Neo entire investment thesis. During this speech, CEO William Lee made a statement that went under the radar of almost every financial news outlet. He said Neo's biggest milestone last year wasn't hitting a profitable quarter. It was that their service and community revenue surpasses 10 billion yuan for the first time. Wall Street values Neo like a traditional legacy automaker. They look at the price to sales based strictly on car deliveries. But Neo is not just selling hardwares. They are building an entire recurring revenue ecosystem. What inside that 10 billion yuan service segment? The world's largest battery swapping network, power charging infrastructure, Neo Life merchandise and brand monetization, after sales services, insurance financing, and used car platform, tech licensing and exports. As CEO William Lee pointed out, selling the car is just the step one. The total addressable value across the entire lifetime of the vehicle ecosystem is vastly larger than the initial metal and wheel transaction. Look at what's happening with their battery swap tech right now. Rivals heavyweight like Chery just bought 10% stake in Neo Energy Technology subsidiary. Rivals are actively buying into Neo's infrastructure because building a competing network from scratch is capital prohibitive. Neo is becoming the Android of battery swapping infrastructure, while everyone else is trying to build proprietary outlets. Now let's look at the operational execution. In the first 7 months of 2026, NEO delivered 227,000 vehicles, an impressive 68% year-over-year growth. In Q2 alone, they moved 207,000 vehicles, up nearly 50% year-over-year, driven heavily by high-margin premium models like the flagship third generation ES8, which crossed over 33,000 units in Q2, and the newly launched ES9 flagship SUV. NIO has proved its command in the premium EV segment in China. Furthermore, institutional money is quietly stacking shares while retail panic over headlines. In Q2 2026, institutional buyer outpaced sellers, growing their net position in NIO by 2.5 million shares. Wall Street institutions don't buy millions of shares of a dying brand. They buy when the valuation is disconnect from the real fundamental execution. And the real growth explosive hasn't even fully hit the balance sheet. They have got the multi-brand strategy, Neo, Onvo, and the Firefly. By segmenting their business into premium Neo, mass market, and compact entry Firefly, Neo is following the exact playbook Toyota used with Lexus and Volkswagen used with Audi, owning every bracket of pricing curve. Here, I would say that investing in disruptive growth is never a smooth upward linear trajectory. It is, as William Lee accurately described it, as a marathon on muddy road. When you see headlines quoting a CEO talking about pressure, self doubt, or maintaining determination, you have two choices as an investor. You can panic, react emotionally to short term fear, and sell at historical cyclical low. Or you can look at the cold hard fundamentals. Over gross margins expanding to 19%, over 6.7 billion in cash reserves. Revenue from service scaling past 1.5 billion at over 20% margin. Year-to-date deliveries up nearly 68%. Institutional accumulation turning positive. Strategic partnership with legacy OEMs validate their battery swap tech. NIO is doing what legacy auto management teams are terrified to do. They are taking the short-term hit today to build a moat that will be utterly unassailable 5 years from now, when we can shake out under the pressure of finals in the EV market. The companies left standing will control the largest automotive market on the earth. NIO has tech, the cash, the charging infrastructure, the sub brands, and the most importantly, a CEO who refused to compromise long term victory for short term stock hype. If you are holding NIO stock, focus on the operational metrics. Watch the Q3 trajectory and ignore the noise because the foundation is built. The execution is showing up in the margin expansion, and the long term thesis remain firmly intact. So hold tight. With that said, thank you so much for being here. See you in next one.